Welcome to the first video in series of trading tutorial playlists that are geared towards taking from an absolute beginner to a complete and properly schooled and tutored trader. And so this is starting from this first video. We're going to start with an introduction to forex trading. So what exactly is forex trading? What exactly is this thing that you've choosing and decided to learn? Now, forex simply is the buying and selling of currencies, the exchanging of one currency for another. When you buy a certain currency by selling another currency and converting it, right? You might have been involved in forex trading at any time in the past. Think, for instance, probably you travel to a different country, to a new location, where their currency happens to be much more different than your own currency, and so you had to go to a bank or go to a bureau of change and have it converted. What at that moment, what you involved yourself in or participated in was forex. The full meaning of the word forex stands for foreign exchange, right? So it's basically an exchange of foreign currencies. Now, the forex market is full of big participants, like big money participants. Daily, it is estimated that the amount of money that flows in and out of the forex market, the foreign exchange market, is an average of $6.7 trillion per day. And so it's a market that has there's a large margin for earnings and earning potentials in the forex market, right? But basically, you must have realized that what you are actually trying to learn is a lot different from the traditional exchange and buying and selling of physical currencies, because what we do when we trade through a broker on our phones or on our laptops, on our devices, does not equate to us getting a physical currency. If, for instance, I sell Canadian dollar, or I sell Japanese yen for Canadian dollar to buy Canadian dollar on my phone through my chatting software, or through my broker, I don't get Canadian dollar delivered over to me, but I still get to earn money, right? And so what that is, or the reason for that, is what I'll just quickly explain in a bit. Now, most people call what we do retail trading, and I think that's actually is a proper name for what we do. We what we do is retail trading, and the reason why we can participate in the forex market, despite the fact that you need big money to actually most times participate in the forex market, to be a big time participant. The reason why we can do it easily with small cash, small resources, small capital, from our homes, from comfort of our beds, without even actually purchasing those real physical currencies, is through an individual called a broker. Now, a broker is a third party individual, an intermediary between you and the market. Your broker creates the environment that mimics or tries to imitate the real environment where currencies are traded in the world, all around the world, worldwide. And your broker creates a simulated environment that actually shows real-time price movements to you, so that you can make informed decisions, just like big time investors all around the world, on the relative strength and weaknesses of currency pairs. Now, in when it comes to forex trading, we every currency is paired to another currency, and they are called currency pairs, and in each pair we have what we call the base currency and the quote currency. Now, the base currency is simply the currency that usually comes in the names. When you see the name of those currency pairs, the base currency is the currency that comes first. And what the base currency is the major currency in that pair. It's the currency that you actually sell the quote currency to get. And so, for instance, in a pair like CAD JPY, the base currency in this scenario, the base currency is CAD, Canadian dollar, right? And it means that every time I click on buy, what I'm doing inadvertently is I'm selling JPY to buy Canadian dollar. And anytime I click on sell, it means I'm selling Canadian dollar to buy JPY. Now, if let's say we are looking at the chart of CAD JPY, if we observe that the market is selling, price is selling, what that implies for us is that JPY, which is the quote currency, currently has more strength than Canadian dollar, and so because of that, the market, we have more investors selling CAD to buy Canadian dollar. But when you observe the chart and see that the market is bullish, buying, moving up, what that tells you is that Canadian dollar is seen by investors to be currently stronger and than JPY, than the Japanese yen, and so you have a lot more persons selling Japanese yen to buy Canadian dollar. And so when the base currency is always stronger when the market is bullish. If the market is buying, if price is buying, it's an indication that your base currency is bullish. And if the market is selling, it's an indication that your quote currency is stronger, not bullish, stronger, right? And so that's it for currency pairs. And then we're briefly talking about a broker. A broker is the intermediary that allows you to trade, that gives you the opportunity to actually even profit from the movement of these currency pairs, right? It's all because of your broker. And any money that you're paid from your earnings comes from your broker's pocket. And that's why when starting out in trading, it's very important that the broker you sign up with is a broker that is, first of all, reputable, and then the broker should also be a broker that has the ability, that has the finances and the willingness to pay you when you are right on your directions, on your trades, right? And so I'll just quickly list a couple of for Africans especially, a couple of reputable brokers. We've got Xnest, we've got Deriv. I use Deriv mostly, more than Xnest even. You've got Blueberry. Blueberry. They have nice spread. Blueberry. I think these are the three I'm sure of that actually do pay and consistently pay out. Xnest, Deriv, Blueberry. I'll pick Deriv over Xnest and Blueberry over Xnest. But because of ease of opening as a Nigerian, Deriv over Xnest, then Xnest next. But they are all reputable brokers, right? So now that we're done with that, let's talk about how you actually trade, how your trading is actually made possible. Now, remember I told you that we don't, when we place a buy or sell, we don't get physical cash or physical currency, but we still get paid, we still get the profit. Now, this is because when you trade through a broker as a retail trader, what you are learning and getting into, when you trade through a broker, you're actually trading a contract. And it's a specific kind of contract. We trade a contract, and that contract is called a CFD. Now, what does CFD stand for? CFD stands for contracts for difference. Contract for difference. Now, if you are opening an account with a broker, you usually see this word CFD written there. CFD account options. There are different kinds of trading scenarios, trading situations, trading activities that you can undertake to actually profit when it comes to the financial market through a broker, right? But CFDs are what we trade. Now, what's a contract for difference? A contract of difference is literally what the name says it is. It is a contract, and it is a legal contract that is binding on you and also on your broker. Now, on your side, what the contract for difference does for you, it has the benefits and it has its disadvantages, both for you and for your broker. Now, the benefit for you, which is the benefit that every person goes into trading to try to actualize, the benefit that the CFD gives you is that it binds upon your broker, makes your broker liable and compulsory, makes it compulsory for your broker to pay you whatever the difference is between your entry price and your exit price when you are right on direction, when you placed a good trade. Whatever the difference is between the price at which you entered the trade, and the price at which you exited the trade, that difference. Now, there's a method for calculation of that difference, and it's the particular lot size you used will also come into play, right? So the lot, it's that difference is multiplied by the lot size that you used, right? But basically the difference between your entry price, entry en, I'll just write that en, the difference between your entry price and your exit price, ex, it makes your broker liable and makes it compulsory that your broker pays you that difference, and that's what you get as profits in your accounts when you finally close your trade. But it also comes with its cons too. It has its pros and it has its cons. Now the con for you is that it also makes it right and legal for your broker to take whatever money you risked on any trade you placed when you are wrong. And so the contract for difference is a two-way fair, and it's a fair exchange. It gives your broker the right to take your money when you're wrong, right? And but in the case of your broker is taking the difference between your entry price and your stop loss price. And a stop loss is something we'll get to talk about, right? And a stop loss, this is one of the reasons why it's very important that you use stop losses when you are trading. The contract for difference pays your broker from the difference between your entry price and your stop out price or your stop loss price. You don't have to get stopped out. I'll explain the difference in later videos or in this video probably, right? And so, but it also makes it possible for you to take your broker's money too when you are right. And so this is what the contract for difference does. And that, so whenever, keep in mind now from now on that whenever you place a trade on your chart or on your MT5, your MT4, or whenever you've placed a trade like that before in the past, what you did was you bought a contract, you sold a contract, right? And that contract was binding for the duration of that trade and made it legally possible for either you or your broker to profit from one another, right? And so this is what we do in trading. This is why when you buy gold, you don't get physical gold sent to you, or when you sell gold, you don't need to have physical gold to sell to actually make money from it, right? And so I think I've still got a bit of time on this video, and so I think I'm gonna go into talking about certain important things that you will need to know if you are going to succeed or last in the long run as a trader. Now, I made mention of certain things: entry price. I talked about stop loss and also stop outs. I think I also include take profits and then lot size. Now, what's starting with entry price? What is your entry price? Now, your entry price is the price at which you place the trade. Now, if you look at this is a charting software. This is TradingView I'm currently on, and this is typically how every chart is. Every chart you will come in contact with or you will use, whether on your MetaTrader 5, your MetaTrader 4, or on your TradingView. On the right side of the screen, you have the price of that instrument, right? And then at the bottom you have dates, right? So it's dates, time, and price, right? And your entry price at whatever trade you place is going to be placed at a certain price. And so that the price at, let's say I placed the trade, a buy at 117.411. That is my entry price. That is the entry price that I entered in on a trade, on that trade, right? And so your entry price is the price, whatever price you entered in on that trade, whether you bought or you sold. And then what is a stop loss? A stop loss is an automatic order that you place in the markets when most times when you enter or you place an order for a trade. A stop loss is an automatic order that you place telling the chart or telling the market or telling your broker, if price gets to this level, close my trade. It means that my trade idea was invalid, so I will cut my loss at this level. But here's the thing: most traders are not okay with placing a stop loss, because most people that I won't even call them traders, because engaging in trading activities doesn't make you a trader. What makes you a trader actually is having a trader's mindset, a proper disciplined trader's mindset. And so most traders, they get into a trade, but they are unwilling to lose, and so most of them don't put stop losses, or if they put stop losses, they keep widening it and increasing it because they would just want to be proven right. They don't want to accept the fact that they were wrong and they're going to lose money, right? And so for you as a trader, I believe that every one of you who's watching this video doesn't only want to learn how to trade, wants to become a profitable trader consistently even. And so whenever you place a trade, always use a stop loss. This is basic knowledge, but it's something you're going to, in the beginning stages, you're going to find hard to do. So I'm helping you out now. It's normal and it's natural, and it's important to use a stop loss whenever you trade. Then the next thing I'll talk about is a stop out. What does being stopped out mean? Now, when you are stopped out, what that means is that you no longer have any capital to hold that trade. All your money, you've lost it. And so whatever trade you were on that caused that loss, it's forcefully closed by your broker. And you want to this is the logic behind it. You would want to be price to hit your stop loss. But what you would never want, and what you should always avoid, is to get stopped out. And how do you avoid getting stopped out? You avoid getting stopped out by using a stop loss. Traders that avoid getting having a stop loss, having price hit their stop loss, always 99% of the time get stopped out, because that's what's going to happen. Because you obviously certainly do not have infinite amount of money in your trading account, and so if you keep allowing the loss run, it will keep running and keep accumulating until the loss becomes bigger than whatever capital you had in your account or whatever equity you had left to hold that trade and keep it running. And so you want to avoid getting stopped out by always keeping or putting a stop loss, right? Then the next is take profit. What is take profit? Just like a stop loss, a take profit is an automatic order that you place at a certain price point that tells the market or tells your broker, when price gets to this level, close my trade. I want to take my profit at this point. This is the take profit level is the point where you want to take your profits. Right? Let's say for instance you won't be on the chart. You won't be able to see anything, and so you want it to be automatically filled for you, right? So then what is a lot size? Lot size is usually the biggest pitfall for most traders. It's where most traders usually die, to put it. Most accounts die, right? Now, a lot size in trading, your lot size is the amount or the quantity of that instrument or that pair that you want to buy or sell. Now, we have what we call a standard lot size. A standard lot size in trading contains 100,000 units of the base currency of that currency that you are trading. So if let's say I used a lot size of 1 on Canadian dollar, like that, what I'm literally doing is I'm buying 100,000 units of Canadian dollar, right? And the thing about using lot size is the bigger the lot size you use, the bigger your profits. The smaller the lot size you use, the smaller your profits, right? But you don't want to fall for that. You don't want to fall for that illusion. If you don't have enough money to use a certain lot size, your account is at risk, right? And the beautiful thing about it is that every broker has a minimum requirement of money you need to have to use a certain lot size to protect you. Protect you and protect your account, to protect you from yourself, because there's always this tendency to want to use a large lot size so we can make big money quick, but it's the quickest way to lose your account. And so the approach to it is that when you want to use a lot size, use a lot size that your account can weather. Or my personal approach to using lot size is this: I decide first of all how much I'm going to risk on a trade, and then I tweak the lot size until I find a lot size that's going to be risking the exact amount I want to risk on that trade at my stop loss. And that's how I go about it, and it has always helped me. That's what we refer to in the trading space as risk management. And so you want to keep all this in mind and apply proper risk management. It is very, very, very important. And so I'll bring this video to an end here, and in the next video we get to learn a lot more.